Okay. All right. Hi, everybody. Thank you so much for coming out to Startup Boston Week. My name is James Coe, and I'm one of the organizers for this event. Before we get started, I've got a few housekeeping matters to go over. On my screen, hopefully this will work. I had a couple issues last time. There you go. So you'll currently see the sessions that are happening right now. So you're logged in to watch shared sentiments. So if you did hope to catch one of the other sessions, please click on agenda at the very top of your screen, and then click join next to the correct session. So on the right side of your screen, I want to point out a couple of tabs. The first is the chat tab. Feel free to use that to share any thoughts or comments about the event or just to engage with fellow attendees. But if you do have any questions for the panel, please use the Q&A tab on the far right of the screen to submit any questions. So that'll make it easier for the moderator to see the questions and get them answered. As this conference is all about learning, so we definitely encourage you to ask questions. So with that, I'm going to hand over the stage to Madison Rifkin. Madison, it's all yours.
Thanks, James. Hi, everyone. It's great to be here. I will be today's moderator, talking with some amazing people about bootstrapping, early stage startups, and really how to get your startup to the next level. So looking forward to doing that. A little background on myself before we start. I'm the current CEO and co-founder of Mount, where we basically outfit Airbnbs with very cool amenities that you all can rent if you show up at an Airbnb. I guess we're in the seed stage, so I've done some bootstrapping as well. I did actually just finished a crowdfunding raise via WeFunder, so I have some pretty good experience there, and really looking forward to diving in with all the rest of the my fellow people in this chat, I guess you could call it, to talk about this. But to start, I'm going to have them introduce themselves. If you guys could just give your name, where you're from or currently are, and just maybe a snippet of kind of your background, and then we can dive further into it after that. Adam, do you want to start?
Sure. Yeah, my name is Adam Roberts. I am currently in Boston, Somerville, actually, technically. I'm a founder in residence at WeFunder, the company that Maddie just raised on. And I'm a former founder myself, also did Y Combinator, but basically I've existed in the startup ecosystem my entire career and really focused on, like, I guess, sales and growth and fundraising.
Awesome. Thank you, Adam. Oriana, you want to go next?
Sure. I'm Oriana. I am mostly in the Boston area, but currently in the New York area. I am the CEO and co-founder of AOA. We're focused on developing a diagnostic test for the early detection of ovarian cancer. Also just recently went through Y Combinator. We were part of the summer batch with our demo day just a couple of weeks ago. And I've been a part of multiple women's health diagnostic startups, also worked in large life sciences companies, always been in biotech, and happy to share about how we essentially bootstrapped the early days of AOA through a side hustle essentially, and then went on to raise our first, and now we're on our second round.
Awesome. Thank you. Very happy to have you here. And last but not least, Ahmed, please introduce yourself.
Hi, everybody. I'm Ahmed Malik. I'm the founder and CEO of Radian. It's a denim brand that was launched on crowdfunding. My background is in finance. Most of my life I worked in credit, corporate banking, M&A advisory, and then I decided to enter the crazy world of entrepreneurship. My in was Kickstarter, crowdfunding, and I've crowdfunded like basically 2 brands, still bootstrapped, still growing. We haven't had any outside investments or anything like that. So we've just scaled up quite fast, entirely bootstrapped, and we're kind of seeing where to go from there.
Awesome. Well, thank you all for introducing yourselves. If anyone has any questions, feel free to throw it in the chat. I think the best place for us to start is actually some background on you guys. Maybe how you bootstrapped your company, because I know from talking to you, it's kind of different for everyone on this call. So Ahmed, let's start with you and how you kind of gauged the market, bootstrapped, and got to a place where you kind of found that product market fit?
Yeah, I mean, for me, it was, I was very happy in my corporate life. I also wanted to I always looked at brands and, how people started brands. And with technology, especially, maybe 2012, 13, 14, when Facebook ads and all this stuff started to pick up, you would see that anybody from any background, you didn't have to be like funded a lot or, have be a Gap or something, for example, in apparel to do new things. And I just was looking to figure out what the product would be. It's a non-linear process. It was more about some fundamentals and then what brand fits in that. Right? For me, it was more about whatever I make, even if it's a small number of people. If they really care about that, that's more important to me than being relevant for like 100 million people, than being a small piece of that. Excellent customer service, something that can scale up ideally sustainably. And then, if you need to raise funding, you do that. The way I did that at least was, just gave myself like 6 months, and I was like, okay, in 6 months, if you can launch this is my set budget. The beauty of Kickstarter or crowdfunding with, kind of Kickstarter-like things is that, you can kind of essentially pitch your product or idea. And if enough people like it, they are your investors, they are your customers. They give you essentially money for you to deliver on that promise, in a few months. And, I did the first Kickstarter, it raised, more than 15, 16 times the goal. That was very encouraging. And that kind of tells you if that company is like a nice product versus like, okay, I'm just going to do this full time for X years and then kind of scale it up and then kind of take it from there.
Awesome. That's really great to hear. I think you have a unique story with Kickstarter, and now that's semi-evolving into this like crowdfunding platform where people, instead of buying product, are actually like buying shares of stock.
Right.
Adam, would be curious to get your take on what you like, maybe for the people out there that don't know about this new type of funding, because it is being used for bootstrapping, what WeFunder is and how you see, early stage startups using this type of platform.
Yeah, a lot of what Amit just said is exactly how WeFunder is being used. So WeFunder is an equity crowdfunding platform. So similar vibe to a Kickstarter, but the difference being you get equity in the company, the investors get equity in your company. So this is done through Reg CF, which is a regulation through the SEC. Only very recently did it become a pretty viable way of raising capital. But what I see a lot of companies, especially early stage companies, doing on the WeFunder platform is that early product validation, right? They're using this as a way to get exposure into getting those early customers that are going to be not only be investors but also spokespeople for your company. So it's a great tool in order to not only get funding, but actually also get early customers who likely won't churn super quickly.
Definitely. That's awesome to hear. I think, WeFunder can definitely be used for testing the market and getting that validation you need to then go raise a large seed or Series A round. Oriana, I'd be interested to hear about your founder journey, because it was a bit different than the others on this call. But really, why did you bootstrap? And then how did you know you got to the point where then you could potentially go full time and look at either taking outside investment or, raising a larger round?
Yeah. Yep. So we didn't do any crowdfunding, but we certainly did a lot of bootstrapping. And we did this honestly by first managing a side hustle to building AOA, which was a small consulting business. My co-founders and I have been in the diagnostic space for a very long time. We've commercialized, we've exited 2 previous companies. And in the early days of doing the research of our technology, we're in the hard tech space in the life sciences. We really need to have good data past a general idea to raise good money. And so we essentially were offering our consulting services to other startups, helping them figure out how to commercialize their technologies while trying to figure out how we were going to do research on ours. And so all that money that we were getting from just doing consulting for other people, we were using to buy samples and to like fund research in the lab. The reason we didn't want to raise money earlier is because the earlier you raise, the more expensive that is for you, in the sense the more diluted you're going to be as a founder. So when you're thinking about when the right time is to bring in money, I really encourage you to think about sort of what are your milestones, what are your inflection points, when are you going to seem really valuable to somebody else that merits you saying, well, I want to hold on to this much of my company because I'm worth this much. And for us, there was a certain inflection point. We needed X amount in the data to really show that this was valuable past just an idea before we wanted to take outside money, start selling shares in our company. So we did that a number of ways. We did the consulting, essentially consulting gigs where we were using our know-how and our brain power to help other startups. In our space as well, we really looked into grants and non-dilutive funding to see what were other ways that could fund the research, competitions and prizes as well. Again, non-dilutive money is something that was just going to not take any shares of the company until we reached a point where we had really good data and we were ready to go out, which happened, our first round happened in January of this year, go out to the markets and start selling shares of our company.
Awesome. Well, you said some great points. You actually got a question. Christopher says, interested to know what milestones are typically reached before crowdfunding is a viable option. If anyone wants to answer that. Oh.
Oh, wow. That's cool.
Didn't know that's what that button was.
I guess I see this all the time. So this is such a it depends answer. You can really be anywhere in the life cycle of your company in order to initiate a crowdfunding round and be successful. I see a lot of companies who are very much pre-product and really in the idea phase, fundraising and through equity crowdfunding. And that usually means that they have a really solid network around them. And that's really where the main contributions are going to come from. Because I think the big key point about equity crowdfunding is that you can raise from anyone. They don't need to be an accredited investor in order to invest in your company. It can be your mom, your dad, it can be your brother, your sister, like it can be anybody. So really early stage, it can happen as long as you have that network who really believes in you as a founder in order to bring in money. But I think, kind of piggybacking on what Oriana just said, like there's a lot of wisdom to be had in not fundraising too early. Sometimes you really do need a little bit of a capital bump in order to just get the project off the ground. However, the longer you can wait, the more product market fit you can prove, the better investment you are in general.
Yep. I just want to quickly add to that where, essentially it's about, for example, for Kickstarter and, that kind of crowdfunding, I've seen people put up projects where they have like a 3D image, which they spend $10 on. It's like, here's my idea. It's great. Now let's fund this. Versus like people or companies that have gone further ahead and created some MVP or minimum viable product or, some semblance to, because it's not necessarily about a milestone. It's more like investors or our customers want credibility, they want trust. If you can create that trust with whatever prototype or whatever stage you reach at, of course, it could be different for biotech, it could be different for consumer products. For us, it was easier because it's consumer products like denim or cutlery and this and that. We know we can get to a certain point, but really focusing on how to build that trust and credibility with whatever stage you've got.
It's a really good point. I am gonna click a button and hopefully this question will disappear, but we'll see. Okay, perfect. Yep. Sorry, it's a new platform. Awesome points. I think that's really great. And then Melissa actually had a question that really relates to what you guys were talking about, but how necessary when you're investing on these platforms or doing like a pre-seed type of thing is like the hero video necessary? Like how much effort and time do you put into it? Is that what people look at when they want to invest? What are your guys' thoughts on that?
I will just say this. I haven't raised on a platform like WeFunder or Kickstarter, but I have done multiple funding events that required a 1-minute video, YC included, and a number of others. And I spent far too much time on a 1 to 2 minute video that I was pretty much guaranteed that very few people watched. I say that with a grain of salt. I haven't done this for WeFunder, but or other crowdfunding platforms. But in my experience so far, I think it's probably 2 to 3 sentences that actually hooks people into what you're doing, something that like really engages them, rather than spending either a lot of time or money on a video that I don't think most people watch.
Yep. Adam, so go ahead, please.
Oh no, I was gonna wait for you to give maybe the Kickstarter perspective. I'll the WeFunder after.
Yeah, because Kickstarter is mostly Kickstarter, Indiegogo, they're very video heavy, because you have all these chances to show on your page, this is my product and this and that, but video really is the key kind of where you deliver your message and story, and so it's extremely important. Now that said, there's 104,000 ways of probably doing videos, like what's the hook and what's the story. But for me, it's always like, okay, let's take a step back and like, why am I making this video? Some people are like, oh, do I have a funny voice? Do I have a stern voice? I'm like, okay, so keeping everything aside, what's your objective, right? You want to tell your story. And I think it's eventually like just telling the product story very simply. If there's X ways of saying something, but if you can just simplify it, be like, hey, this is, in our case, like one of the like world's smallest collapsible transportable cutlery, or this denim has pockets which solves these problems. So we're not necessarily focused on the product too much, but what it does for people, and then kind of how you fit in the narrative. I mean, depends, but mostly that's kind of the goal, I guess, that you want in your video or any asset from that perspective.
Yeah, I suspected it'd actually be a little different. So through WeFunder, what we've seen is, actually the overproduced, heavily edited videos do not perform as well as, I guess, like videos that do focus on the business itself and give an opportunity for the founders to actually convey who they are and their background. And I guess it's kind of the difference here is that, on an equity crowdfunding platform, you are pitching investors.
Yeah.
Right. So they're probably looking at more of like the business side of this, like who are they investing in as people? What are they investing in? Like, what is this business? What are they doing? Whereas I would imagine like Kickstarter, it's actually more important to be a little bit more markety with what you're doing. And so that's kind of the core differences. So yeah, the short answer there is actually like the lower produced, like founders just speaking into the camera about their product and maybe doing some product demo as appropriate in the video actually converts better than an overproduced, like really well done, super slick product video.
Awesome. Yeah, I completely agree. I think, you need some authenticity in there, and that, you need that over Zoom as well when you're pitching accredited investors. So throughout the whole process, that needs to be necessary. We're definitely getting some good questions in our Q&A. Maybe we'll shift to some of those. Jordan asked, these days, how do large cap investors tend to view the presence of unaccredited investors, like crowdfunders, as partial owners of a potential investment? Is that throwing off the landscape? What is that looking like?
Yeah, I'll jump in on this one. Yeah. So, there is still this stigma in the air for sure around equity crowdfunding, right? Because of what it used to be versus now what it is today. It's still playing catch up for sure. So the industry, or I guess like from a product standpoint, WeFunder specifically, I can't really speak to the other platforms. But we have enabled we're using SPVs in order to structure the investment. And that being said, like what it does is it makes all the institutional investors a lot more comfortable with your cap table in general, because it's really just one line item on your cap table, your equity crowdfunding investment. And so from a cleanliness standpoint, they don't see any sort of risk or liability alongside of that. So that's kind of a new concept, though. So we're still kind of working through as an industry the old perception of what we were. But long story short, it shouldn't impact your ability to raise future money or anything like that.
Awesome. Well, thank you for answering that. Just to follow up, sorry if I mispronounce your name, Manalia is asking about does fraud happen in crowdfunding? Either from WeFunder or Kickstarter. How's that handled?
I mean, Kickstarter especially is kind of notorious where a lot of people don't associate it with like necessarily like being very trustworthy, you know. But again, it's a platform. There's all sorts of people come in, Kickstarter, Indiegogo, these companies. They don't necessarily, they're not saying we vet each and every one. Otherwise, they'd be the world's greatest or worst investors, right? Or they can't do that. They don't have the ability to do due diligence. They have some basic rules, and if you do that, that's fine. What I've seen is Kickstarter gets a bad rap because there's a lot of very large product. I mean, there's like a $11 million raise for like some sort of cooler or something like that. They never delivered after 4 years. Now they tried a lot and they failed and everything, because keeping in mind that if you scratch the surface, Kickstarter and Indiegogo, when you're crowdfunding in terms of here's my $50 whatever, and I get like maybe a thank you note or the product in return, right? It's never like a sale and purchase agreement, even legally. Like they're saying that, you know, you're supporting this company, hoping that you will get whatever is promised to you that way, you know, and you're kind of supporting the company for that to make that product. But I have seen instances of fraud, though very small. And it happens, you know, we can't do much about it. But what I see more often than not is projects taking years and years to even try and deliver. And then a small number fails spectacularly. And the others are like just delayed like 3 years. But for the most part, you know, the Kickstarter community is very aware of that. You know, if you're backing something and it's going to be $100 eventually, but right now you're getting it $50, and basically you're voting with your dollars. You want to see them exist. And is one of the best communities ever because they're so understanding, so forgiving. If you're genuine and open with communication, I couldn't believe it. I was like, people are paying us to do beta testing. Essentially, that's how I can sum it up. And they're so nice about it. You can do product iterations, you can get their feedback, but that trust needs to be there and that openness needs to be there. We had a lot of delays. We were always like completely open. Here's what's going on. Sorry about this. We're going to get this in 2 weeks or whatever. But there's tons of people who don't even communicate. That's not nice.
Yeah, I think at least on WeFunder, or I'm pretty sure other equity crowdfunding platforms also, like there's actually very little fraud. And I think that's just because, you know, in order to actually put your company on it, you do have to work directly with the team at whatever platform you're there, you know, on. I guess with WeFunder, we're actually vetting and doing background checks on the founders to make sure there are no bad actors. But also on the investor side, because, you know, they're being awarded shares in your company, there's a little bit more due diligence that goes behind each investor that comes onto the platform before they can actually confirm their investment.
Definitely. And I know in WeFunder too, when I went through the process, I had to get an accountant. They went through all of my financial statements, even though we were pre-revenue. And, you know, I think that's another way to weed out the startups that are just not existent. You know, you wouldn't have any financials or anything like that. So there's that as well on that platform. This is an interesting question from Diva. She says, raising on a safe note from individual angel investors versus an equity platform like WeFunder, which one is more effective for early stage startups with a prototype? And maybe you guys can share a bit more about your experience on when you raised and from what type of investor, because that could shed some light onto, you know who's going to be that early investor. It might not be an equity platform, but it could be the friends and family around you.
I can take a first stab at a high level. I can't speak to using a platform like WeFunder. We haven't used it yet, but on safe versus equity angel investors and whatnot. I think the one thing to think about when you're raising money is not just how much money you're getting, but who you're getting that money from. And especially in the early days, a $10,000 check from a really well-connected investor can be worth so much more than a $100,000 check who you're never going to speak to. You have to balance that with, there are some investors that feel the need to want to hold your hand the entire time and don't really know your business as well as you do. So when you're thinking of your investors, you need to be interviewing them as much as they're interviewing you and thinking this is a long-term relationship that I'm building, especially your early days. They're the ones that are going to see you struggle the most. And so really understanding who you are getting money from, what their expectations are, and what value they can bring to you. In our case, we really have like some early angel investors that invested. We didn't do a safe, we did a convertible note. Happy to talk about the differences, but in any case, premise. We have some of those that wrote small checks but have been instrumental in introducing us to large investors for our greater rounds, in helping us find the right hires, in troubleshooting what was going on in the lab. And so sometimes, having a direct communication line to certain investors is really, really helpful. The other note that I will make on safe or convertible note versus equity, I think goes back to the earlier point, is what milestone are you reaching, and are you ready and to agree to evaluation with those investors. In our case, so in 2020 we were bootstrapped and we had some non-dilutive grants, and then 2021 is when we raised our first round. And so we had some early data. Essentially, I would correlate it to a very early prototype. But I knew that in a very short amount of time, I'm talking less than 12 months, I was going to have an even greater inflection point. But I needed money to hit that inflection point. So I had proof of concept data, but I needed a clinical study that was really, really going to drive the value in that company. And so if I sold equity in January, I knew that my value was going to be significantly lower than in literally just 6 months from now. But I needed money to let me get to that 6 months and to drive that value. And so that's where I see a value in doing a convertible note or a safe, and pushing off that value. Yes, you have to do a cap or a discount, but essentially you're pushing off that valuation discussion. It's a lot more affordable to do a safe or a priced round than a safe or a note than it is to do a priced round that involves lawyers. You don't need to have a lead investor. You can take the biggest value to us on our convertible note and the safe is that you can take checks as they come in. You can close, your friends, your family, your investors, and you don't need to wait for everybody to close. So that meant for those months that we were raising, money was coming into the bank from the first couple of weeks and the first conversations, allowing us to fund that work and hit that milestone faster. And then when we hit that milestone and the data was phenomenal and we did what we told our early investors that we were going to do, we almost tripled our valuation in less than 6 months. And at that point, it's made much more sense to do a price round. We had money in the bank. We could afford the lawyer's fees. We had networked with investors that could lead the round, and sort of the company was a tad bit more mature now to raise the next set of money.
It's an amazing story. If anyone has any questions about that, Oriana's a wealth of information and can definitely share how she got those and figured out what inflection points she was targeting and all that good stuff. In terms of just answering a few more of these questions, they're a bit more crowdfunding oriented. This one is from Melissa. I'm not sure if this is the case with WeFunder, but with Kickstarter, you need to choose a realistic amount. Otherwise, you don't get any of the funds raised. How do you recommend choosing how much to raise?
I guess this is for specific Kickstarter, maybe. So, and of course, WeFunder as well. But since you mentioned crowdfunding, I'm going to take a stab at it. The answer is it depends. For me, before I even started, I saw that a lot of campaigns have like a $5,000, $10,000 goal, which is not necessarily a real goal. It depends on the product. Some products are like, hey, I want to do this art installation on this wall in the city, and then I need X funds for it. That makes sense. But for a product like ours, we're like, hey, we're launching this new brand, or this is a cutlery. You can fold it and you can put it here. You can take it anywhere. Me personally, before I even started, I had literally like 3 goals. First one was whatever like lowest possible thing on Kickstarter. So because Kickstarter, and they have these kind of unsaid rules where you want to hit your goal like in the first few days, 2 days or something. So unless you really need to get to like 50K, 100K, whatever, much larger one, it's recommended you have like a much smaller, goal. That's just, my take on it. And I've seen people do that. The second goal was the one where I was like, okay, if we hit this is my real actual goal. And we're like, okay, if we hit 50K, this means it's not just a goal. It means that this will help us launch and means there's demand past the Kickstarter. I was like, if it does 100K plus, it's going to take a while. This is going to be like a full scale business, right? We're going to not just be like, okay, let's just deliver these all in and see where it goes. It's going to be like, no, this is an all in demand. So I would suggest that keeping, these goals to yourself, because what happens is let's say if you have a 50K goal and you hit 51,000, that means certain something. You should kind of try and extrapolate what your customer, what your community is telling you. Does this mean you can scale it up to a much larger business if you want to, or it has another path? For us, it was like for example, we hit like 250K or something, and my real goal was like 100K, and I was like, okay, there's no question, like you are to scale it up forward, right? And then there's another demand. I would suggest looking at it kind of like this, but it depends on your particular project and your kind of appetite for how much you really want to do this for the next X years or not.
Yep.
Yeah, and on WeFunder, we just have a 50K minimum that you need to hit in order to basically collect. You certainly set goals, like your high-end goals, in order that are more like, I guess, strategically focused around bringing in money. Maybe even Maddie can and speak more to what she did. But yeah, it's just kind of the long and short of it.
Definitely. And I think, I don't know, I mean, WeFunder has like that minimum you're allowed to raise on the platform is 75K. So that's what we set. And I got some really good advice just from founders in the space. You guys might have felt this as well, but even just fundraising in general, the advice I got was have your target goal that you push out to people be smaller than what you think you're going to get. Because when you raise capital, no matter what type of platform or like what type of raise it is, it's better to look oversubscribed than reaching for your goal of 1.5 million and only getting 750K. Fundraising is all about FOMO. And if you're able to get 500,000 right off the bat and be like, oh, our round is full, let me see now strategically who I want to let in on my round, because now I have the power to do that. You're not just groveling for any type of investment. You flip the power dynamic, and now you get the choice of who to bring in, as opposed to trying to scramble to the 1.5 million. And, if people hear your round is only a third of the way full, they're not coming in. There's no incentive for them to. So you got to really figure out how to play the game. That's really what I learned in fundraising is, talk to as many founders as you can, because they're going to tell you how to play the game. And if you don't know how, it's really hard.
If I could just add to that 100%, I can say that happened to us in both of our rounds. We went out with just under what we would ideally want, but enough to hit an inflection point, essentially, being comfortable with like what level we wanted to oversubscribe to. The first quarter, it was like pulling teeth. And then when we were about 80% funded, it was fire. And we got to choose who we wanted to work with. We got to really be picky. We decided to oversubscribe a little bit, but because we knew that we were going to be doing the next round very soon after, around YC's demo day, we had, walking into our next investment round, we had 50% of the round already soft circled from oversubscribed interest from the last one that we had. And so then we started this round with 50%, and people were like, you're already at 50%, you just opened the round. And so, the size of those rounds were substantially different. But again, it's the percentage. People were like, you're already at 50% on day one of you fundraising. And so really, really, I absolutely agree. It's like, it's all about the perception, and like, think about something even in your everyday life, when something is limited edition or something's only on display for a month at a museum, everybody wants to go then, but if it's there forever, then you never really end up doing it. And that's the exact same thing with fundraising. The one thing I will say to that is really manage that with a realistic number, because far too often investors will catch that and be like, is that really how much money you need? And then they will doubt your ability to manage a business, because they know enough. They've seen so many startups, and they know that, I don't know, to run a clinical trial, it costs $1 million, and you're saying you're only raising 500,000. Then now you come off as uninformed, because that's not how much it costs to run a clinical trial, and you don't know what you're doing. So you have to manage that with like a realistic number and sell that number while also projecting to be oversubscribed.
I think, actually, like, what I've seen is a lot of really smart founders who are like currently fundraising will actually combine an equity crowdfunding round with just a normal angel and VC round, and use that allocation that they're giving to equity crowdfunding to drive that urgency. So immediately they're saying, okay, so we have 500,000 allocated of our $1 million round. And that's already gone. Like, so now we only have 500K that we can offer these institutions or angels. And that in itself instantly, like, basically builds your up to your soft circle 50%.
Yeah, I can't agree more, Adam. That's exactly what we did. We did part of our raise on WeFunder actually specifically so our customers could be investors, because we felt like they were our initial kind of, people who were like, oh, I love this, it works. We wanted to give it back to them and let them be investors. But then we also on the side brought in institutional investors and a few startup accelerators. So yeah, you can kind of get very creative. There's no rule book at the moment. So, you put your round together how you want. I don't know if everyone can see the questions I'm viewing, but people are putting in really good comments in the questions section. I guess I can just read them, because Benjamin had a good point. He says, Kickstarter is very political. It's extremely valuable to know someone at the platform to get your project on the front page so that you can hit your goal before you even open it to the public. So I think that really just goes back to what we were all just talking about, just in raising in general. He says you can do that because they will allow the project to open but not go public for 3 to 4 hours. WeFunder's the same. So really get your friends, families, and investors you already know to hit that goal, and then the public will be like, let's go. So that's exactly how WeFunder works.
I want to make one clarification in that knowing someone at WeFunder is not going to help your page. It is not political. We are heavily regulated by FINRA. So literally all of our emails with founders are actually read by the government. So like any sort of like that, like that kind of stuff is not how it works. You have to hit funding milestones in order to get certain exposure on the platform.
No, completely agree. Yeah. And the WeFunder team is also very helpful. You get to meet all of them. So it doesn't matter either way. I pushed a lot of my friends and family to the platform before it went live. So in that sense, we have a question from Ian. He says, what type of industry or like what types of industries are most successful on crowdfunding?
Gosh. I actually get this question a lot, and there really isn't a sweet spot. It's, I think that people, I guess like for WeFunder, this may actually be very different for Kickstarter. But you would think like Kickstarter, WeFunder would excel in like consumer products or something like that. Something that like people can really touch and feel and invest in instantly. But it's just not the way it plays out. Any company can do very well on WeFunder if they're a good investment.
I definitely, Adam, like you said, like it's a little bit different in Kickstarter where, you need tangible products. I mean, you can't be like, hey, here's my biotech company. Nobody would know what to do with it, right? It's like, hey, people want to see cool stuff. They want to, maybe it's a new kind of widget or gadget. And then I've seen projects that are like, you're like, what is this even, right? And they have, it's a board game and they raise like $10 million. I still I could work my whole life and not do that. I just don't know how they did that. It's amazing. And it just depends, and also it's all kinds of creators. Some people are like, I just want, a couple of $1,000s for a certain like art project or something like that. But anytime you see anything more than a couple of $100,000 of on Kickstarter, you should know that it was a proper product launch. Most likely, I can't say for everybody, but for most likely, like treated like a proper product launch where a lot of work went before that. Because the amount of times I've had people talk to me about who want to get into crowdfunding or something, and they're like, "Oh my God, I had this amazing idea. I should have just put it on Kickstarter. You raised so much X and Y Z money. Oh, that would have done great." And then I don't even know where to begin to say that doesn't work like that. It's not like it's amazing idea. You put it up on Kickstarter, 30 days later, here's $1 million right there. No, it's you grind, you hustle. Like the first few hours, friends and family, I called everybody and like, please buy my product. The first few hours, and of course after that, you're spending money on ads. Like any product launch. Of course, WeFunder might be a little bit different from that, but it's really like depends on the kind of thing. But mostly tangible products will work, and those are the ones that you'll see like scale up a lot. Could be a tech product, could be like apparel, could be anything pretty much.
It's a really good point. I guess speaking to that and going back, like you're just talking about the whole fundraising in general, Diva has a really good question about time of raising. And is it okay to do it before beta testing? Is that going to be effective, or do you really need to have a product service in hand of your customer before it's a good idea to raise?
It always depends, right? So I think the thing to remember is that you aren't raising on your product alone, right? There are so many things that investors are looking for when they're considering making an investment. So maybe, yeah, you're pre-product, but you potentially have all these other amazing attributes that make you a really solid investment. Like, for example, maybe you have an exit already as a founder, or you just have really deep industry insight. Your team is amazing. Maybe you do have early traction. Like, so you just have, like, you have to I guess, like, kind of like really spell out every potential value point you have as a business and make the decision based on that. It's like, are we a good investment even without our MVP fully launched yet? But I will say right now, it's pretty rare.
Yeah, I would agree with that. I think the one thing Mount did to get really creative about it was we created kind of FOMO with our customers and created like a wait list. We posted in a Facebook group where we knew our customers were, and we're like, if you're interested, sign up. Got 500 signups. We didn't really anticipate that happening. And then we're like, oh, let's use this as a traction point on our raise. And then we slowly took people off that wait list. But if you don't have a beta, we've seen people do that as well. Just to you really just need to gauge your market and see, are people interested, validate it, and all of that stuff. Oh, yeah. Corey just agreed. He's like, would you recommend an app with a 5,000 plus waitlist to utilize crowdfunding sites and no beta? So
that's certainly worth a conversation.
Right.
Like that's the thing that, you have 5,000 people that you can instantly reach out to around your crowdfunding play. Which is, I'll be honest, that's not a huge number, but it's certainly something.
Definitely. Yeah, it's all about your network. I guess this is a good one too. Melissa asked a question about like when you're raising from family and friends, how do you approach them in not a rude or uncomfortable way about getting money? I don't know if you guys have thoughts on that.
I would honestly, I would share with them your idea without asking for money first. So it's like, I started a company and I'm really passionate about this and I'm really excited about this and this is what I'm doing and we're currently raising money. And I'd be happy to share this if you think there's anybody in your network that might be interested in supporting us. And most of the time, they'll think of somebody, but they'll also think of themselves because again, like, they probably believe in you and they don't want to miss out on the opportunity either. When I was first raising, I didn't go to all my family members. I literally just told my parents, and then my other family members heard about it and they're like, I don't know, why wouldn't you tell us about this? We'd love to support you. And so, much more than going to anybody, and this I think works for any investor, it's like, don't go asking for money, go to share your story. Go to get people excited about what you're building and what you're working on. And more times they'll want to give you money because they'll want to see you succeed. And then they'll want to be a part of the success as well. So just think about it as, updating them on a milestone that's happening in your life and something that you're passionate about. And then the other thing that I will say is be prepared to have some very basic investor conversation. So we wrote a script, which was like, what does a SAFE mean? What does a convertible note mean? What does it mean to be an accredited investor? How do your shares convert? Because your friends and your family are most likely your most naive investors, I'm not trying to say that in a rude way, but it's just like they may have never invested before. And so, really, really keep in mind that you know how to explain it to them, because it's also the money that you're going to feel the most awkward about down the line. If like they had a certain expectation, there with convertible notes, there are certain tax declarances that they have to do at the end of every year. And so if you can inform them on that and just make them comfortable as well, just like keep that in mind.
Yep, I think that's a really good point. And I always went into my family and friend conversations with just like, hey, here's what I'm working on, would love your advice. Do you have any thoughts on like a specific point? And then when they get really invested, they're like, oh my God, I want to be an investor. Or, you could always ask them for advice on an investor conversation and get them thinking that way as well. I'll be like, oh, I have this really important meeting. How would you handle this? But yeah, I mean, it shouldn't be awkward. They're family and friends, they're going to want to support you first and foremost. It's not really about the money for them. They just, want to show their support, and what we found on WeFunder as well. I think our session is about over. Oh no, we have 15 minutes. Yeah, so that was the questions that have rolled in thus far. I guess we can get back to some of the programming per se, but how did you guys go about finding your initial investors, either institutional or not? But what did you do? Did you put together a hit list? Did you have people in your network that introduced you? How did you handle that initial kind of outreach?
I can start. So start with your low-hanging fruit first, which is usually your friends and family. And it also allows you to start sharing your pitch and discussing your pitch and getting feedback before you have to go to more institutional investors. So in general, whenever you do a fundraising round, do not have your first conversations with your most coveted investors, because like you fine tune your pitch and you practice as you go. So always start with friends and family, because they will always be usually easier to convince, and the first checks in and how to get to your FOMO feeling, because then like just with friends and family, you'll be like 30% filled of the round, etc. And then the second best, in my opinion, has always been warm intros. And so that's from colleagues, that's from your friends, that's from your bankers, from your lawyers, from your consultants, from people at conferences, from panelists that you meet. Really think of your network as extremely broad, and ask for introductions, but don't ask for an introduction like, hey, can you introduce me to any investor? Like really have a clear ask. I'm looking for life sciences investors that focus in women's health, something that within your network, or I saw that you're connected to so-and-so on LinkedIn. Would you be able to offer me an introduction? Always provide a forwardable email. So like a blurb or something. So make it really easy for them to do that introduction. Everybody's really busy. But everybody always wants to help. I've never asked anybody for help who's actually denied it. Just make it easy for them to do so you don't have to chase them for that follow-up. And then always do your own research as well. And like really, we created our own internal, I would say, database of as many investors as we could find that might fit. There are so many investors out there, and the more they fit to you, the higher likelihood of success you're going to have. So in our case, we could go to generalist investors that invest in everything, but then we're competing with all sorts of technologies. Then we could go to life sciences investors. Okay, that's more niche and they understand, what we're working on. And then diagnostics investors, and then narrow it down to femtech investors. And so the more specific those investors are, the higher likelihood you'll have of success. But really fundraising is a numbers game. The more people you're speaking to, the faster you're going to raise and the more success you're going to have. So I would say it's just like target your easier ones first and then go out into the universe before you do your cold outreach. At least that's what worked for us.
Yeah, I would agree with that as well. I didn't know that in the beginning, and I went to some top tier investors with a story that was all jumbled and made no sense. So definitely nail your story. I'd say it takes at least like 30 to 50 times saying it to like have it actually make sense to everyone else, because I was very close to the business, as you probably are with yours. To you, it makes sense. To everyone else, not so much.
Right.
Yeah.
I just want to add, for me, it was completely different, because I think when I was starting something, the part of my framework was something that where I don't necessarily need to go raise right off the bat. I think I'm all for raising capital, and that's the way to scale up a lot of things. But if and when you need to, for a lot of companies, and they're like raise first, then do. I don't kind of get that. So for me, it was like something I can just launch by myself. So I just bootstrap, like put a big chunk of my savings into it, and then I was like, okay, worst case, then I can it fails, and then I can do something else or change jobs or something like that. But I think more important at that stage was it's still convincing vendors, everybody else I'm going to work with, like, why do they care about this thing, right? So you still needed that story, that element of, kind of selling, because very few people realize that when you're a startup or you're a scrappy startup, even though vendors, a lot of them will be you're going to be their customer, most don't care about you because you're so small and nobody wants to take a risk. So that narrative is super important on what you're going to do and why it's going to be so big. In getting quality people to work with you, right? Otherwise, they have so many options, and then you can't even pay them that well. So I feel like it was similar in what Oriana was also saying, kind of having that pitch ready for the right people you want to work with. Kind of sounds strange, you're pitching to your vendors, but happens more often than not at early stage startups, more than you can think of, and that was super helpful to have that good narrative there.
Yeah, I think that that's like an awesome technique, right? And something that I personally value a lot when I think in this context is traction and hustle, right? Like around like how the founders were able to actually kind of bootstrap to a certain point. And if you lack the network, right? Which I think most people, frankly, like aren't part of the club, which is so it's understandable. I think it's probably not an undervalued route, but like going the accelerator route is a really, really, really great way to inject yourself into a network of investors and investment opportunity. But usually what that means prior to is that, accelerators certainly have some requirements, right? Like, and so I think that, all the bootstrap work you're going to be able to do beforehand to get that early traction in order to, get into an attractive accelerator program. That's a great way to get in front of investors. Yeah. And of course, I mean, like equity crowdfunding as well, in order to just make it kind of open for everyone. So they don't have to be an accredited investor to actually put in money to your company. Just opens up the doors completely, as opposed to seeking accredited investor introductions all the time.
Definitely. And Adam, what I found as well with my WeFunder raise is that then when I applied to an accelerator kind of in tandem to the WeFunder, they were checking it and they saw it go up and up and up. And they're like, in our interview, they're like, this WeFunder, like what's happening here and why are you raising? And I was like, oh, it's from our customers. And when they heard that, they're like, oh, this is a proof point for this startup. It actually helped me get into the accelerator. So you can use it that way as well. Diva had a really interesting question, actually. She said, when raising, is it suggested to wrap up the round in a shorter period of time, say 1 to 2 months, or over a long period of time, 3 to 6 months? If anyone can shed some light on that, because that was something I struggled with as well.
Your job is to run your company, not fundraise. You need to close it as quickly as possible.
100%. Close the round as quickly as possible. There are limited situations, where it makes sense to wait for an investor, but I would say that's like, you have to be in a very, very particular situation to do so. Most of the time, 99% of the time, close your round as quickly as possible. Do not hold out for big names that one day may or may not join you. Just get back to work.
Yep, I completely agree with that. Diva, the one thing I learned actually fundraising that I didn't know in the beginning is that although you're like starting your round and closing it within a month, the pre-work before you start raising is very important. And it sometimes takes 6 to 9 months where you're developing the relationships. So this timeline isn't like I'm starting relationship, they're going to invest in a month, and then I'm going to close my round. You're like doing reach out, generating relationships, 6 to 9 months before then they're even going to consider investing. So that's the thing that I don't think a lot of people talk about, is like this pre-relationship to really then bring in investors. I don't know if you guys have experience with that as well. That's how we got our first investors. It took 9 months.
Absolutely. I think there's a lot that goes into building a relationship. This 1 to 2 months of fundraising is like, we're literally talking diligence and documents signed, right? Like there is so much that happens to get to the point of diligence. And so a lot of the time is like when you're not actively raising, you are actively networking and having conversations. You're thinking about who do you include on your investor newsletter updates. Always have investor newsletter updates. And who are you keeping in the loop? How are you attracting people in conversations? We anticipate closing this round very soon, and we won't have to raise another round until the fall of next year. I have already scheduled 3 major investors for meetings in December of this year, which is like, hi, it doesn't make sense for us to connect for this round, but like I want to build that relationship, and they want to build that relationship with me too. And we're meeting in December, which is like off funding cycle for us, but it's purely to create that relationship. So when the time does come and I say, hi, so-and-so, we're going to be raising money, then they know, okay, Ariana's doing this, she's building this is her story, this is what she last told me, and like, where are we right now? Okay, let's get into diligence.
And yeah, I think that it almost makes sense to break it down, your whole fundraising into phases, right? Like your pre-phase where you're developing that rapport with investors, because ultimately, you don't really want to be pitching investors for a very long period of time. Like if you can contain your pitches to like 2 weeks, right, where you've already built the rapport with a whole bunch of investors, you schedule everybody for the same 2 weeks, And then, of course, it's going to take it may take a longer to actually close out the round, but your pitches are really compartmentalized into a small period of time. That is actually going to help you with the urgency side of things as well, to actually close the round and get the money in the bank.
Yeah, completely agree. You definitely need urgency. We're getting a lot of good questions actually off of this conversation. Corey asks, have any of you been given the runaround from an investor, high energy to start, great willingness to invest, that ended up with an investor disappearing after constantly positive discussions?
Yeah.
Who hasn't? I don't know.
It's the name of the game. They're never going to tell you no because they don't want to look like that person, if you do well.
And I think that, when it comes down to pitching investors, like certainly you want to establish a relationship, get excited about working with these people because they're about to, join your business. But at the same time, you can only, don't hold on to the deals too tightly, right? Like don't get too committed to them. It is kind of like they need to prove to you that they're going to be a value add to your business. Right. So, don't squeeze too tight on any certain investor to hold on to them.
I would absolutely agree. Investors are notoriously nice people. Like they will ghost you before they officially turn you down. So if they're not getting back to you, assume that they've ghosted you and move on. And then don't take it personally. You just don't take it personally and move on to the next. That's why the numbers game is really important.
And I haven't raised, but I've worked with a lot of startups and, seen different stages of raising or helped them raise with I do a lot of financials and business model stuff. I have also seen those emails come back to life right after, the startup raised or is in the process of raising and they've heard through the grapevine or a certain announcement comes out and they're like, oh, hey, what's up? Are we still in? And even the pricing changes and everything, and they're still in. It just, it's the name of the game for investors. It's a hard job also for them, and they don't want to say no, but again, you never say never. It can also come back. I've seen that a couple of times at least.
Okay, Madison, we've only got a couple minutes left. We're gonna wrap up. So,
no worries. We'll probably take one more question, and I think this is a good one to end on. What if you're not able to raise your goal and you cannot keep the round open because it looks bad and doesn't help with creating FOMO amongst investors? What do you do? That probably happens quite often.
In my opinion, close the round, get back to work with the money that you have, get to a certain inflection point. Even if it wasn't your originally planned inflection point, get to a inflection point that allows you to show progress and then do another round. So I'm going to give an example. Let's say you're trying to raise 2 million, but you can only get 1 million. Okay. And with that original 2 million, you were going to conduct a 500 patient study, etc. Okay. Now you have 100 million. Oh, excuse me. You have 1 million instead. Conduct a 200 patient study instead, and essentially paint that as your next milestone, drive that action, and then go out and raise whatever you need at that point as well. Don't be in this perpetual cycle of trying to get to 2 million, trying to get 2 million. Close what you can, do the work that you can, and then try again later. Because a lot changes. It's not just your company changes, the market changes, investors change, your competition changes. So sometimes it's good to get a break and then go from refresh.
Yeah, I feel like if you feel like you put an extreme amount of hustle into your round and it just isn't working out, that is the market telling you something.
Right.
Yeah.
Very good point about the amount of hustle. Fundraising
Yes.
is not easy. It is
hustle.
not easy. It is a huge grind. It is incredibly time consuming, very emotionally draining. If you expect it to be a breeze and have some conversations and money to be rolling in, that is a false expectation. If you are hustling really hard and it is, as a CEO or whoever the one that's raising, it is all that you're doing and you're doing nothing else and you're having multiple meetings. And by multiple, I mean you're talking to 100 investors. You're talking to a lot of people and you're really putting yourself out there and you're doing really good follow-up and you're answering good questions and you're giving it your absolute all and you're not able to raise money, then absolutely take a break. If you're going about it leisurely and not able to make money, then you're not actively fundraising.
When I failed, I had pitched 70 investors and closed 3 of them. So, yeah.
I mean, you really have to work hard in a startup to fail. There's a lot of hustle. You have to hustle, and then even before you even get to the failure part. So, hustle.
And failure is not bad. You learned a lot off of that.
You move on and pivot, move on, take the money, do something else, or do like Oriana had a great example. That's perfect. Like, just then take a break, get those deliverables, and then on to the next objective.
Definitely.
All right. Well, thank you all. I'd like to thank the speakers for a great session. We've got more content coming up, so be sure to click on the agenda on top of the screen. Check it out. We'll see you all soon. Thanks, guys.
All right. Thank you. Thank you, everybody. Bye-bye.
Thanks.
Thank you.
Thanks. Bye.
Bye.